Meet Priyanshi. She's a nurse working at one of the finest hospital chains in India, Goat Hospitals. On paper, her job requires her to work 10 hours a day, but it could easily go up to 14 hours. Sadly, she doesn't make a lot of money, but she helps doctors save lives. Her patients love her, and the satisfaction this brings is enough to compensate for the fact that money is tight. There's thousands like her that Goat employs. It's one of the most respectable and reputed chains in India. One day, however, the director of the hospital calls for a meeting. He says the family trust that owns the hospital chain has now decided to sell it to a private equity company called Aditya Capital, the company that I own. He reassures them that this is merely a change of ownership. Nobody is losing their jobs. Aditya Capital is just here to make things more efficient. I too join that meeting and contribute to the director's reassurances. I tell the staff that this is an excellent hospital, but there are a few inefficiencies here and there that I'll hopefully resolve and maybe sell the hospital to someone else tomorrow at a higher price. It's just an investment. 3 years later, most of the nurses have lost their jobs, including Priyanshi. The few that are remaining are working overtime with no extra pay. Most of the doctors have left, and the quality of patient services is in shambles. There's always a supply shortage. The hospital has skipped pest control for more than a year. The director had to take a major pay cut. There's cockroaches everywhere. The name Goat Hospitals isn't even close to what it used to be before. Finally, the hospital management announces that they have no choice but to shut down the entire chain. Everyone in this equation is worse off. Everyone except me. Aditya Capital made almost 500 crores over the last couple of years, and me, being the general partner, got enough money in commissions to buy a nice penthouse in South Mumbai. Welcome to the messed up world of private equity, where a new kind of Midas's touch has taken hold. Everything that private equity touches turns into ashes, except it produces gold for the private equity company alone. Okay, everything I just told you, is that even real? You bet, 100%. It happens every single day. And before we see how legal it is, let's understand how it works. Okay, private equity is just like a mutual fund, but for rich people. Unlike a mutual fund where a group of people come together and invest in publicly listed companies, a group of rich people come together and invest in privately held companies. They come together, pool all of their money, and hand it over to a manager. The manager, with his team of analysts, decides which private companies to buy today and hopefully tomorrow sell them at a profit. That's it. It's exactly like what you and I do with mutual funds. Now, going back to our example of Goat Hospitals, let's say the chain is worth 1000 crore rupees. Now, I, with the help of Aditya Capital, come in and take out a loan from a bank for 800 crore rupees. I then put in 200 crores of my own investors' money and buy Goat Hospitals as the majority shareholder. Now, look at the genius. I borrowed 80% of the money to buy Goat Hospitals, but this loan won't be paid off by me or my investors. I would transfer this loan directly onto the balance sheet of Goat Hospitals. The hospital chain with its revenue is required to pay off that loan, even though I used that loan to acquire controlling rights to that hospital. But that's not even the most exploitative part. I then split Goat Hospitals into two companies. Let's call them Goat Hospitals and Goat Asset Leasing, or GAL for short. Now I take all of the hospital's assets and transfer them to Goat Asset Leasing. This includes the hospital building, the land on which my hospital buildings are located, the hospital beds, the fancy equipments, every single asset. Now, Goat Hospitals owns nothing and GAL owns everything. GAL then charges rent to Goat Hospitals for using all these assets. Now you might be wondering, what's the point of this? Bear with me. So far, nothing has changed. This is just a restructuring. Earlier, Goat Hospitals was making money and the money was staying in, but now Goat Hospital is making money and that money is just flowing to Goat Asset Leasing. Everything is ultimately owned by me, so how does it matter? But now see what happens. Over the next few years, I start increasing the rent that GAL charges to Goat Hospitals. I then go to a bank and tell them, look, I have this company, Goat Asset Leasing, that is growing so well. This time, however, I use the entire loan money to pay a big fat dividend to Goat Hospital's shareholders, who are, you guessed it, me and my investors. I keep doing this and the condition of my hospital keeps worsening. But look at what happens to the financial statements of GAL. As a standalone company that charges rent for various things, their revenue keeps going up. I take these financial statements and then go to the bank again. We're in the business of asset leasing, and look at how our revenue has grown by 30% every single year. And that's all because I decided to increase the rent by 30% that I am charging my own hospital. But the bank doesn't care. They're happy with the growth, so I tell them I need another 800 crore rupee loan to expand. And then what? I keep doing this as long as goat hospitals can survive. I don't pay for pest control. I keep making my staff work overtime. Whatever money I'm saving by laying off people, I use that to pay bigger dividends. And then finally, when the hospital itself is in the ICU, I go back to the bank and do a willful default. I tell them that, look, we don't have money, we can't pay you back. The bank comes in and starts selling all of Goat's assets to recover the loan money. The hospital beds, the land, the high-tech equipment, the building, every single thing. But guess what? Over the last 5 years, real estate prices have risen so much that even though the bank gave me a 1600 crore rupee loan, by just selling the building and the land, they're able to recover more than 2000 crores. Whatever they make from selling the equipment is just bonus. So after recovering their loan and the interest, the remaining amount is handed back to the shareholders, which is paid out as a dividend. This is 100% legal. It happens every single day and even has a term: dividend recapitalization. But you know, private equity wasn't always like this. So we have to ask, how did we even get here in the first place? You see, for rich people back in the 1950s, the stock market wasn't enough. They wanted more returns by investing in private companies. But this came with a problem. Even for the richest of the rich, buying a private company isn't easy at all because it doesn't have a stock that trades on an exchange like the NSE. Moreover, valuation is a nightmare. Unlike public companies, these private firms aren't required to tell you every single quarter how much their revenue is growing. Plus, a lot of these businesses were owned by families, and if you wanted to buy shares in them, you would have to pay whatever these families asked for. So a group of fund managers saw this and said, you know what, this looks like a real problem. Let us solve it for you. We'll assemble a team of analysts, use different ways to value these companies, negotiate with the existing owners, and decide what to buy and sell on your behalf. You can just pay us fees for doing this. The rich people loved this. It was an amazing pitch, except even the private equity firms struggled to buy private companies. Just because you now have a team of analysts, it doesn't mean private companies suddenly become more transparent and liquid to buy and sell. So private equity firms thought, how about we just buy private companies at whatever prices and not tell our investors how much these companies are actually worth. For instance, in 2019, a private equity company called NCAP valued one of its oil companies at $773 million. In just 1 year, this company went bankrupt and had to be written down to $0. Are you seriously telling me that the private equity company had no idea that an oil company with so many physical assets isn't struggling just 1 year before its total collapse? And this lack of transparency is something that private equity managers absolutely love because it's easier to prune your portfolio and make it look like all your companies are doing great to attract more business from other rich investors. But wait, this isn't sustainable either. You remember my PE company, Aditya Capital? I could keep doing this, but what if tomorrow my investors ask for their money back? Not only can I keep lying forever, even if theoretically I invest in the best companies possible that make a lot of money, it's very difficult to give my clients money back to them. Say Aditya Capital purchases a 50% stake in a $2 million company. A couple of years later, this 50% stake is worth $2 million. Now, the overall market has crashed, and even though this company is profitable, the investors are now getting fearful. They say, before things get worse, let's cash out, sell this company urgently. Now, even though our 50% stake is worth $2 million, double of what we put in initially, this is a fire sale. Finding a buyer as it is takes weeks. Moreover, I am desperate, so I might have to sell it for $1.5 million because the stake is so huge. Then finally, the tax man comes for the gains, which are again higher than the public market, leaving my private equity investors with very little money. Plus, the paperwork to transact in private markets is very expensive. The taxes are also high, and I would also be charging fees. So after everything, a $2 million stake gets sold at $1.5 million, and there are additional deductions, leaving my clients with very little money. The stock market was just easier to operate in. So private equity firms thought, what if there are some ways in which we could make money from our portfolio companies without ever selling them? ways that are questionable. This led to the beginning of the leveraged buyout and dividend recapitalization era. In 2005, three private equity companies, Bain Capital, KKR, and Vornado Realty Trust, bought a company called Toys R Us for $6.6 billion. On paper, the idea was we'll buy this company today for $6 billion, improve its efficiency, and maybe a couple of years down the line sell it for $12 billion. But just like Aditya Capital and Goat Hospitals, these funds also took out a loan of $5 billion and transferred it onto the balance sheet of Toys R Us, leaving them with zero liability. Now, I'm about to tell you the shadiest part, but I hope you understood every single thing I explained up until this point. Actually, let me rephrase. I don't hope, I know you understood it. Not because it was easy to understand, but because I did a great job explaining it. And that skill is why you see all these views on a YouTube channel with no YouTube shorts. That skill is why I get to work with all of these brands and turn content into a full-time career. That skill is why I get to have a team of 6 people. And this wasn't a gift, it was learned and perfected. My videos used to look like this. And you could do the exact same thing without buying an overpriced course. With the help of this book, a #1 Amazon bestseller, Creator to Crorepati by yours truly. All you need to know is that the world's biggest publisher, Penguin Random House, backed this book in not one but 2 languages. It's available in both Hindi and English and distills my 5 years of experience creating content so that you don't make the same mistakes as I did. If you want to learn how to become a creator, I've linked the book in the description, and let's now move on to the shadiest thing about this acquisition. Because of larger chains like Walmart and online expansion by Amazon, the toys business was already struggling, and now they had no money left to figure out how they could expand online. The already struggling company now had to deal with $5 billion of debt, the annual interest expense for which was more than $400 million. Now there was no money left to expand online and compete with Amazon or larger retail chains like Walmart. So what? The company went bankrupt, 33,000 jobs were lost, but these funds made more than $500 million with the help of some very shady fees. So, after the purchase of Toys R Us, the company signed an advisory agreement with these 3 private equity firms. Let me say that again slowly. Toys R Us, the company that these 3 funds purchased, now signed an advisory agreement agreeing to pay millions of dollars in advisory fees to the same 3 funds that now fully owned it. What's even more sketchy is that this advisory agreement said nothing about the nature or the frequency of the advice being given by these funds to Toys R Us. It even explicitly said that it's not compulsory for these 3 funds to offer advisory services to Toys R Us, but it is compulsory for Toys R Us to pay advisory fees for this service. It's like your gym telling you to pay fees for 365 days, but they'll just decide when they want to keep the gym open. And that's not all. Toys R Us was also supposed to pay huge transaction fees. Take a second and understand how absurd this is. An acquisition is not a straightforward transaction that I went out and bought shares in a company. You need investment bankers, lawyers, independent valuation experts to help you do this, and they cost a lot of money. Money that the acquirer is supposed to pay for. Let's say you and I enter into an agreement wherein I am buying your house for 1 crore rupees. I spend 5 lakhs on a lawyer, 5 lakhs on a valuation expert, I do all my due diligence and then tell you I'm only going to pay you 90 lakh rupees because it cost me so much money to do the due diligence. All of these fees were paid for from the revenue of Toys R Us. That's how exploitative this deal was. In 2010, a fund called Cerberus acquired a 31 hospital chain called Steward and did exactly what we saw in Priyanshi's example. The PE company came in, started renting out the hospital's assets back to the hospitals, and the rents got so high that the hospital went under. In certain branches, the pest control was delayed for so many months that they had to remove more than 3,000 bats from where patients slept. And guess what? Neither the pest control company nor the hospital's other vendors were ever paid for any of the services that they offered. Most of the hospital vendors had cut off the entire chain. Different branches had to swap equipment with each other just to get by. This went on for 10 years before the chain went under. Some of the the vendors sued the hospital chain. The pest control company, for example, wasn't paid more than $1.6 million. But you know the outcome? They got nothing because the hospital owed all of these amounts, not the private equity firm, which by the way made more than $800 million from this investment. And in case you think this doesn't happen in developing countries, specifically India, wake up. We just don't have enough data around it. What started as a way to give people access to the private markets has evolved into something so monstrous. If private equity consumes everything in its path, if the vendors are losing, the employees are losing, the creditors are losing, the consumers are losing, then why aren't we regulating this better? Why is it even legal to do what Cerberus did with Steward Health? All hope isn't lost though. Steward Health, the hospital chain's creditors, have sued Cerberus. They argued that the dividends that the hospitals paid Cerberus were essentially stolen from the company. Depending on the outcome of this case, maybe we could see some change. But the biggest takeaway here is that if regulators can spend so much time on the public markets, why not on the private markets? The argument is that the private markets don't affect people the way public markets do, but look at these examples. How is this not affecting you and me? Sure, Toys R Us affected consumers who are buying toys, but the fall of Steward Health affected patients. What do you think about this? How can we solve this problem? I'd love to know your thoughts in the comments. And if you learned something new, subscribe to the channel and get my book Creator to Crorepati with the link in the description.